Welcome back to this Money Control live stream. You're watching Closing Bell with me, Nandita Khemka, and my colleague.
Hello there, I am Yatin Mota.
Well, I'm surprised that Yatin didn't have anything to say about my comeback, but yes, this was not the kind of welcome I was hoping for. Given the fact that we've seen such a deep sell-off on Dalal Street today, a confluence of factors really at play here. First of all, it was a virus scare, that saw the street sell off, and how. Given the fact that the Nifty, in fact, broke below that 24,600 mark at one point in time. I beg your pardon, 23,600 mark. 388 point cut on the index, 1250 points down on the Sensex, which is below that 78,000 mark at the current juncture. And even the broader end of the market saw very deep sell-off, right? Both the Nifty mid and small cap indices, Yatin, were down over 2.5 to 3% apiece. As I mentioned, a confluence of factors, 2 confirmed cases of HMPV virus in Karnataka and a suspected third case in Gujarat. However, there's no confirmation to that effect. But don't forget that I may have come back from my vacation, and so have the FIIs. In January so far, last 3 sessions, we saw the FII turning net sellers once again. And the long short ratio is in favor of shorts, right? So there is bearish sentiment among FIIs once again, even though December we saw some bit of buying coming in. But FII come back, also dollar strength and rupee hitting new lows consistently. These are some of the factors at play, which is why we saw such a deep sell-off in the market. Talking about today's action, the advanced decline ratio on the NSE was 1:9. I think 1 advance to 9 declines. That's the kind of poor breadth or dismal breadth we saw. The VIX, India VIX, has jumped over 16%. That's a fair bit of volatility. And don't forget, this is the week when we kickstart the earnings season, and a lot of reactions to the third quarter business updates were also seen today. But in terms of sectors, all of them were deep in red, led by PSU banks, Realty, metals also as a pocket, down by 2.5% or thereabouts. If you look at some of the key losers today, ITC, of course, trading ex hotels business, was down 8%. You had Trent, Tata Steel, you had BPCL, given the fact that crude is once again, back above that $76 per barrel mark. So OMC is feeling the heat. Coal India, NTPC, and all the other counters, most of them were deep in the red. If you look at the negative contributors on the index, it was led by Reliance Industries, HDFC Bank, which by the way reported its third quarter business update. Street didn't really take it very positively. Trent, M&M, these are some of the other top contributors to the Nifty's fall today. Gainers were few and far between. No points for guessing. Hospital stocks and diagnostic stocks were all up in today's session, of course, on the back of the virus scare. Tata Consumer Titan, which reported third quarter business update, which was quite good, so to say. So it was reacting to that. And HCL Tech was one counter that was doing well. But Yatin, business updates from Union Bank and Bank of Baroda were clearly a dampener, given the fact that the Nifty PSU Bank index dropped in excess of 3% today.
Absolutely, and if you look at the Nifty PSU index, none of the gainers there, all index constituents ended the day lower, average 3 to 4% losses. Union Bank, obviously the reason being that both deposit growth as well as advance growth on a sequential basis fell. Year-on-year basis, we saw some dismal performance for deposits. And if you look at Bank of Baroda, not a very bad number, but the deposit growth was much lower than market expectations. In fact, it was lower than the advance growth, also clearly indicating that if banks were to keep pace with the advance growth of 15-20% moving forward, the deposit mobilization is not that great in the marketplace, forcing borrowers to probably have a look at other alternative sources, which will probably put impact on their net interest margins. If you look at the Nifty 500 gainers, we had Linde India, 5% up. Obvious reason being that during pandemic COVID-19, the company was a sole supplier of oxygen, and with the virus scare, along, we have hospital stocks, diagnostic stocks moving, but also Linde India moving, on the back of the retail buying which is there. Equitas, ease my trip for the other gainers in trade. What did not do well is the likes of HEG down 8%, Swan Energy down 8%, Union Bank, obviously we mentioned the reasons as well, and Intellect Design Arena also witnessing some profit taking. But Nandita, on our channel CNBC Awaaz and TV18, we spoke to a slew of experts on the virus, and there is no particular reason why the market should panic so much. It is not as bad as the COVID-19 virus. The virus has been there for like the last 3 decades. It impacts people with smaller age or probably age above 70 years. I think much of the population need not worry. But yes, initial 2-3 cases found in India, especially the southern states, led to the panic, especially in the HNI desks, wherein a lot of unwinding is seen. And as you were mentioning, the FI short interest is also high, so no interest from there also, leading to a big sell-off in the markets by almost 400 points. So remember, Europe is up almost 0.25%. Japan is up, Korea was up 2%, Dow futures were in the green. Despite all of these factors, we had the Indian equities which clearly underperformed not only Asia but the globe.
That's true, Yatin. And the Nifty also has broken below its 200-day moving average level. That's some bit of a scare there. But of course, in terms of preparedness after COVID, states have issued advisories. Yeah. So we will be better prepared to handle something if at all it kind of exacerbates or something like that. But right now, as Yatin mentioned, it is too early to actually panic over the situation. But on that note, let's take a look at the stocks that are on our focus or on our list this afternoon. Of course, we've spoken about banks and Realty and PSU banks, all of them bearing the brunt today. But it's all about beauty and food when it comes to the stocks that I have selected, because they have been doing well today on the back of upbeat third quarter update. Starting with Nykaa, fashionable gains today in a weak market, although the business updates suggest that the good news is not really led by fashion, it's led by beauty, because the net revenue growth for the company Nykaa is likely to be higher than mid-20 levels, and the beauty vertical is something that is expected to drive this growth. The beauty vertical growth has accelerated vis-a-vis previous quarters, and the beauty business net revenue growth has exceeded mid-20 levels. The beauty business gross merchandise value will be likely in low 30s. That's a good news, because this will be driven by strong momentum across all of Nykaa's beauty businesses, be it e-commerce platform, be it retail stores, owned brands, as well as B2B distribution network as well. The B2B distribution platform, which is Superstore by Nykaa, has seen very good growth. The platform now accounts for 8% of the beauty vertical vis-a-vis 7% a year ago, and the Superstore by Nykaa service now, in fact, it services approximately 26,000 transacting retailers, as well as it caters to 1,100 cities. If you look at the fashion vertical, no fashionable growth expected there, but it is expected to deliver net revenue of somewhere around 20% or thereabouts. Net sales value growth is estimated to remain in low to mid-teens, but this does reflect sustained growth in content, marketing and service-related income streams as well. The online fashion demand continues to be subdued, but the company is pretty much confident on the long-term opportunity in fashion despite the subdued demand seen in the online platform. Now, JM Financial has come out with a report post the third quarter update. It has reiterated the fact that Nykaa remains one of the top picks for this brokerage when it comes to the internet sector. They have a target price of 240 rupees or thereabouts on the stock, and they've pointed out that the kind of growth that Nykaa has shown in the third quarter business update, it kind of negates the narrative that quick commerce can erode into the growth for Nykaa, and the BPC business rise in quick commerce is unlikely to come at the cost of Nykaa. That's what GM Financial believes rather. And they've also said that channel checks suggest that Nykaa fashion would still have gained some bit of market share, given the fact that online fashion has seen quite a bit of pressure. So despite muted demand, Nykaa fashion seems to have gained some kind of market share there. If you look at the stock, hasn't been doing all that well in the last 3 months, but over the last 1 month or so, the stock has been picking up steam. And if we see the kind of performance that the third quarter update has shown, who knows, Nykaa can take off. And as GM Financial has already pointed out, it is one of the top internet picks for this particular brokerage. Absolutely, and Nykaa really doing well in a volatile market. Obviously, as Nandita was mentioning, the stock has corrected from the highs it made post the IPO, but now I think probably some good growth picking up. Obviously, the online commerce, e-commerce business remains slightly subdued, but the overall sales have seen a double-digit growth, as per brokerages. Now, if you look at other stocks which are on our focus list, clearly we have SBI Cards, one of the top F&O gainers in trade today. Obviously, the stock cooled off along with the markets, but two brokerages today were upgrading the stock. Nomura has upgraded the stock of SBI Cards to a buy. Target price has been raised to a level of 825 by almost 200 rupees. Now,
Nomura believes that the near term might have some issues with relating to asset quality, but the company is a big beneficiary of rate cuts moving forward, which will help them regulate their cost of funds. Also, if you look at the share of metro region in credit card debt, that has been gradually rising since FY23, and companies like SBI Card probably would benefit from this trend. Also, the share of top 8 metro cities in new sourcing has been rising for SBI cards, which is a good sign. Overall, the card addition might not be that aggressive, but yes, the company has been able to maintain their market positioning in the tier top 8 cities. Nuvama also today upgraded the stock of SBI cards. They have increased the target to a level of 850. The earlier target was 620. So, good target increase. Here also, Nuvama believes that the credit cost will peak from second quarter of FY25 onwards and would remain stable in the current December quarter and moving forward. Also, if you look at Q4 onwards, the expectation of brokerage is that the credit cost will decline, and with the rate cut probably coming in, the entire benefit probably would pass on to credit card companies like SBI cards.
That's true, Yatin. And SBI card as a stock has seen good traction in the last 5 days. Also, it has gained somewhere around 10% or thereabouts. Of course, all these upgrades also boding well for the stock. But from beauty to food, Yatin, that's the favorite topic. Jubilant Food, that's the other stock that's on my list today, saw good gains in a weak market. In fact, the stock has seen a rally for the 4th straight day, hit a fresh 52-week high as well today, but cooled off from the day's high, but still managed to end the day in the green. The third quarter update has been pretty delectable. The third quarter consolidated revenue has grown 56% on a YY basis, and the revenue growth, this is on a consolidated basis, and that's why it takes into account the acquisition of DP Eurasia. Now, DP Eurasia is a master franchisee of Domino's Pizza in Turkey, Azerbaijan as well as Georgia, and this acquisition enables Jubilant Food to deepen its footprint in another large emerging market, which is Turkey. And also, of course, gain into the country's large cafe market through DP Eurasia's coffee brand. Now, it holds over 94% in DP Eurasia. It completed that, the residual stake acquisition in early 2024. Now, the standalone revenue for Jubilant Food has grown 18.9% on a YY basis. There has been steady demand across its product range. In fact, if you look at Domino's India like-for-like growth, it has come in at a good 12.5% in the third quarter. And even if you look at the store network, Jubilant Food store network reached 3,260 outlets by the end of the December quarter, and there has been a net addition of 130 stores during the quarter. 60 new Domino's stores were opened during the quarter. And if you look at the numbers, the third quarter numbers, the key to watch out for will be the like-for-like growth in delivery as well as dine-in business rather. Another factor that will be key to watch will be the gross margins from the changes that the company has made to its beverage portfolio, along with the growth in the Popeyes business. The company, last week has signed a memorandum of understanding with Coca-Cola for the purchase of beverages and food products. Now, Jubilant will acquire a portfolio of sparkling beverages and select other items from Coca-Cola's authorized bottlers. Now, the arrangement will help Jubilant to enhance its consumer offerings as well. Some of the brokerages have recently upgraded their target price on this stock. In fact, Jefferies had raised its target price to 1,000 rupees from 800 rupees earlier, and it expects the same store sales growth for the company to be in the mid to high single digit range. In fact, Jefferies has also pointed out that margins which had hit their lowest in early 2024 are now positioned for further improvement. Of course, in the wake of rising input costs, margins were a pain point for most of these QSR companies, but now that is expected to change. In fact, even HDFC Securities had assigned an ad rating for this particular stock with a target price of 690 rupees, anticipating strong performance in the third quarter, or in fact overall for FY25 in the QSR space. Stock, if you look at it, has done fairly well in the last 2 months. It has gained in excess of 30%. Yatin.
And the good part about Jubilant Foodworks is that for the start of FY25, it was not that great in terms of like-for-like growth. I think management realized this, quickly turned the tables. They improved their in-house dining experience. They changed the menu. They also offered, free delivery in select pin codes. I think that strategy has worked well for the company, and probably 12.5% kind of a like-for-like growth really augurs well, and probably the reason why the stock did well. Obviously, if you look at the Bharatiya Group, recently they acquired the Coca-Cola, bottling unit as well, and they changed the Jubilant Food Works arrangements from PepsiCo to Coca-Cola. Probably that will help them better margins, if not at a similar level to Pepsi. But clearly LFL number of 12.5% encouraging in a tough market condition where food inflation continues to remain high.
That's true, Yatin. And even the same store sales growth, expectations are mid to high single digit range. If that happens, of course, who knows, the stock may take off. And of course, this being your birthday week, maybe you can treat us to some pizza as well later this week. But I think with that, those were all the stocks that were on our radar this afternoon. Not very good news. In fact, this is not the kind of welcome I was hoping for. It did turn out to be a manic Monday. But let's hope that the kind of reaction that we saw in the market, let's hope that it's just a knee-jerk reaction and things, get better as we proceed further. Not to forget that we have TCS earnings lined up on Thursday. That will be another deciding factor as to which way the markets will swing. The third quarter earnings season, much to watch out for when it comes to that. But with that, it's a goodbye from me and Yatin. Thanks a lot for tuning in. Stay tuned to Money Control for all your other news and updates, and have a great evening.